All right, all right. So there's a lot to cover over the next 40 minutes or so, and I appreciate some people may be quite hungry, quite a few other people quite jet lagged. So first of all, I'd like to thank the awesome team involved here in Salt Asia. I've done countless of these conferences and speaking gigs, and this has to be one of the most seamless I've seen. So special shout out to Helen, Sarah, and of course Joe and John, as well as the dream team over here. Thanks to the panelists who managed to make it. Joe and Daniel being the OGs, Maurice flying in very kind of last minute from Rotterdam, representing the HODL group, and of course, we got Singapore's own son with Kelvin from Coinhako. While the panel title has been unchanged for the last 2 weeks, the obvious backdrop in the industry has been anything but, right? Half of the original panel I had got liquidated for one reason or kind of another. And there's still a lot of ongoing things. So we're going to structure it as follows. We'll kick it off with first having 30 to 60 seconds intros from each of the panel. We'll kick it off with Kevin starting things out. I will then attempt to set some context for those of you who are not necessarily following the space or maybe only been watching it from a distance. And then we will open it up for a little bit of kind of freestyle. Yes, we will eventually touch on digital assets in Asia, but not talking about crypto from a meta perspective is like talking about the east wing of your house. When the house is on fire, it's getting flooded, you have squatters. So we got to start top line first before we get to Asia. And we're really going to try here and aim for signal over noise context. And obviously nothing here is investment advice. We're going to get some things fabulously wrong and fabulously right 6, 12 months, 2, 3 years down kind of the line. The objective here really is to give our esteemed audience context, frameworks, and potential pathways on how to think about the space, whether you're a builder, an investor, or both, right? So here I'd encourage the panelists to agree to disagree. Sometimes you can disagree to disagree, and then don't be afraid of kind of playing devil's advocate. And obviously when we touch down the session, each one of you will be given 30 seconds to have some kind of closing remarks that you'd like to leave our audience with. And let's keep the energy going and the enthusiasm high. Why don't we start off with intros on your side?
Hi, good afternoon or good morning. My name is Kelvin. I've been a trader for the last 15 years, mainly an options trader in New York and in Singapore. Started the digital journey, crypto journey pretty late during COVID time itself. The light bulb moment was trying on to go into metaverse 5 minutes after, got a headache. Maybe it's because I'm old or something like that. Wanted to give up. My eldest son walked by. He said, "Dad, let me try it." And so I said, "Okay, why don't you go ahead?" 10 minutes later, he showed me he started riding a dragon onto Decentraland itself. That is how fast the next generation is. That made me realize the next generation of users, the next generation of customers are already living in the digital space. So anybody that wants to succeed in the next decade, regardless of what happened over the last week, will need to have a Web3 angle strategy installed for them. Coinhako obviously is a MES licensed crypto platform. Started in 2014, which is really pretty solid history already, considering all facts. Right now we're pivoting towards institutional space. We have a full suite of product for the institutional, high net worth, and family offices based on digital tokens.
All right, Dan, intros?
Sure. Dan Roberts, co-founder, co-CEO of Iris Energy. We're a NASDAQ-listed Bitcoin mining, data center, and infrastructure business. All traditional backgrounds in investment banking, infrastructure funds management. The opportunity we saw in Bitcoin and crypto was really Bitcoin mining was a sector that was growing in size and scale, is profitable even at these levels, vastly misunderstood. It requires a lot of infrastructure to be built out. With our backgrounds in renewable energy, we saw firsthand the opportunity to monetize this stranded excess renewable energy that we're building out, particularly across Western markets globally. We listed on the NASDAQ 12 months ago. It's been a heck of a ride, but look, my brother and I, my co-founder and co-CEO, we've been in the sector since 2013. I think 3 months after we bought our first Bitcoin, Mt. Gox went under. History never repeats, but it does rhyme. These centralizers, exchanges seem to pop up each cycle, but no doubt we'll touch on that more of that.
Thanks, Dan. Maurice?
Yes, hello. Thank you, Kay, for hosting this panel, first of all. My name is Maurice Mureau. I'm the CEO of HODL. And HODL is, as I always called it, a building company into the blockchain and crypto space. We've been around since 2012, so early days, helping companies and individuals in their first blockchain journey. We grew out to be a leading European company in the whole ecosystem of cryptocurrency and blockchain. So we do incubation, we're still helping companies on the journey. We have ventures, we have an algorithmic trading bot platform, and most of all the part where I'm in is our investment funds. And we look at our investment funds from a different perspective than most people are used to. We're in there for the long run. We look at it from a risk perspective, and we try to get investors aware this should be a very small but interesting part of your portfolio, and in that way the risk can be balanced. I'm looking very forward to this panel actually, digital assets in APAC. I think it goes a little bit broader than that, and yes, seeing the recent events, I hope to get you all sort of back in track where the digital asset world can bring us, instead of looking back on what's happened in the last week and the weeks before.
Awesome. Thanks. Maurice. Joe?
Good. Good morning, everyone. I'm Joe Marenda. I'm a partner at Cambridge Associates. I run our digital assets investing group, which is both research as well as working with client capital. Cambridge, for those of you who don't know us, it's about, it's 49 years old at this point, turning 50 next year. We invented the endowment model, which is the broadly diversified portfolio construction that most institutional investors follow today, heavy on alternatives, for example. We have about $550 billion of assets under management, and our clients are endowments, foundations, pensions, ultra-high net worth families, and sovereign wealth funds. We have 13 offices around the world, 4 on this side of the planet. I began working with clients in 2016 looking for funds to invest in. Couldn't find any that passed any screen at all. There were a few. Began actually deploying capital in 2018.
Awesome. Fantastic. All right. So I'm going to do my best to set the context here, and then we'll open it up for kind of initial thoughts from the panel. And this is actually the first kind of context piece that I've ever had to written, which just shows kind of how dire and interesting things are. So 1 million, 2 million, 2.5 million, 5 million, 10 million, 50 million. These are the amounts that have been lost in FTX with people that I know directly, including myself, who had money with FTX. The last two, the 10 and 50 million, are actually hedge funds. So this is not a context of sophisticated or unsophisticated. I think a lot of people are missing the significance of what FTX kind of looked like in the space. So for those well-versed, new or agnostic to crypto, even the Salt Asia conference gives a great anchor point to what has changed in the space over just the last 2 weeks. Like a lot of other leading conferences, Sam Bankman-Fried, SBF, the founder, CEO of FTX, as well as a whole bunch of other senior FTX officials were some of the original VIPs who were going to be here. And why not? After all, they represented what it was to be a tier 1 exchange for years. He was the new kid on the block, the golden boy who could do no wrong, and was leading the charge to meet regulators, policymakers, as well as politicians. On top of that, Sam wanted to give away all his wealth for impactful causes. Very, very different from the Lambo to the moon crowd that you typically see in the space. So what was there not to love? So the space, be it directly or indirectly, wanted to believe. Media could not get enough of this guy, and politicians, especially the Democrats, were getting sizable donations, so there's probably a few Dems who are going to be crying over the next kind of few months. They finally seem to have a grown-up, quote-unquote, representing the interest, quote-unquote, of the space. Now, within the last week, FTX International and FTX US filed for bankruptcy. I believe they did so on Friday, and part of that included over 130 entities, which tells you that this is a lot more complicated than just an exchange. While all of this is still fluid, it seems that the entire world was hoodwinked by SBF and the senior management team at FTX. Outright fraud seems to be the case here, where once again we're seeing customer assets being used to plug excess risk-taking and leverage that was tied to Alameda Research, a market-making and hedge fund firm owned by who? You guessed it, SBF and the crew. Now, obviously, for those of you in finance, this is nothing new. We've seen this game many times, as well as in venture, Theranos, Bernie Madoff, etc. But I think the screaming paradox here is Sam was literally berating these fraudulent moves just a few months ago when we had the multi-billion blow-ups and contagions from the likes of Terra Luna, Three Arrows, Celsius, BlockFi, with a few of the people behind those actually being very central and key to Singapore. And what actually seems to be the case is that Alameda Research was probably insolvent back then. And the only way to save it was to move funds over from the CFI that FTX is. And this obviously has resulted in the cascade over the last 1 to 2 weeks, with just $5 billion of deposits being taken out of FTX, I believe 2 Sundays ago, and of course the cascading drama ripple that we'll be seeing. I'm sure there'll be movies, Netflix series, spin-offs, and books off of this, something similar to kind of The Big Short. But outside of that, the space has naturally gone on to make new lows. We have Bitcoin in the high teens. We have Ethereum closer to like 1,000. Interestingly enough, ETH did make new lows. And the crypto market now sits at $850 billion, which is 70% lower than obviously the 2.8 trillion top that we saw at the end of last year. So there are cries yet again that the space is dead, that we're still seeing outflows from obviously CFI to private wallets. There's talks of DeFi over CFI, talk of DeFi also being dead, regulation coming to kill the industry, and that this is crypto's 2008 Lehman moment, etc. With that as a setup, I would just love to turn it over to the panel, and maybe we can start from Joe and move down. What was your kind of thinking in the space from just 2 weeks ago, right? When I think the main consensus is we're clearly in a bear market, we're all watching the Fed, we're waiting for the macro pivot, and then of course what's kind of happened. I'd just love to see, and you, your firm, maybe some of the smarter people around you, the delta that we can share with the audience.
Yeah, so prior to this, I actually was thinking that while we were in a bear market, we were through the worst of it. The worst of it at that point was defined as Three Arrows, Terra Luna, the summer. We have always been focused on blockchain as a technology, and the cryptocurrency, that idea, never really resonated with us. But this idea of blockchain being a fundamentally new technology that would disrupt and disintermediate existing businesses and create new business models was, and still is, compelling, but we always viewed this as potentially a risk asset, not as a diversifying asset. And it was business as usual 2 weeks ago. And, we were still committing capital. There was just a close actually for a fund that we'd invested in 2 to 3 weeks ago. And then, of course, now this happened. And what's been fascinating is that the interest is actually like what happened. I mean, they all want to know whether or not they had an exposure, those sorts of things. But after that, it's simply, why did this happen? And this is a very easy story. You basically said the F word. That's pretty much it, as far as everybody knows right now. It is not like the summer where we had Terra Luna Anchor, which is just incredibly complicated and hard to explain to novices. This is a really simple story. Bernie Madoff with crypto. What it has done, though, unfortunately, is extended the crypto winter. I don't have any clue now when we're going to get out of this. But what I do see is continued deployment of capital by institutions, but at a much slower pace and at a much smaller size, given that valuations have come down so much, they don't need to deploy as much. And I think it simply delayed the on-ramp for major institutional adoption, a year or two, and then there's the whole regulatory issue, which is also out there.
Got it. Maurice?
Yes, Kay, I'd like to sort of look at the broader picture. We've been to many cycles. We've seen events like this before. But if you look at the economic situation we're in at this moment, that is far more important. I think 1 or 2 days after the FTX, the S&P had its best day since 2020 because the inflation came out at a 7.7 figure. Well, I don't know which economic school you went to, but where I come from, I've learned that if you're losing on your savings 7.7% annually, that means in about 7 years, your real value of your money is halved. So government policy, monetary policy, is actually the main issue here. And what we need is a sort of a reset of the financial system, and there is where the digital assets can be really helpful. What happened last week doesn't help for the trust in the space, but if you look at the fraud that is happening in with FTX, I can also say maybe government policy is a fraud. Maybe Morgan Friedman was right when he said, history of mankind is history of money losing value. How are we going to be able to do our global trades and make sure our pensions are safe if the government is screwing up our money? Excuse my language. But it is unprecedented that we are in times where the inflation is so high and the interest rates are still very low. We try to raise them, but how far can we raise them when the government's debt has been in all-time highs? It's difficult, and I think we don't need to look backwards and see, okay, what has happened to FTX is bad. Now we really have to look forward and see what can it bring us, what can we learn from it, and how can we kind of progress from here, make sure we don't make the same mistakes. We said that when Luna happened 6 months ago as well, and probably we will say it a few more times, but I'm pretty sure that in the end, people actually can see what the technology is all about and how it can help us build a new financial system, but also help us with global trade.
Fantastic. Dan, you mentioned Mt. Gox before. You've clearly taken, punches to the face multiple times in the cycles. What was the thinking from Iris?
Yeah, look, I wouldn't say you become numb to it, but the irony is one of the pioneering voices in this space, Nick Szabo, one of his favourite mantras or sayings was trusted third parties are security holes. And time again, every cycle, we see the centralisation element of the industry lead to these issues, and it's obviously devastating when it happens. The cycle repeats. 99% of the new tokens projects are launched with what I politely call limited use cases, but it's the part of any new technology. For us, our journey began really early. We saw Bitcoin, bought it high, sold it low, silly magic internet money. We went into the Ethereum pre-sale at 30 cents, obviously did well out of that. But around 2017, the penny really dropped where we said Bitcoin's different. There's only 21 million. You can't stop it. You can't kill it. In a world where the fiat system's becoming increasingly fragile, a digital store of value has value. And that was enough for us to build a business around. The broader ecosystem, I think, holds a lot of promise beneath a lot of the more shallow promises. I think as a society, we are trending more away from governments, technology companies, and their encroachment on privacy, censorship, etc. And this technology is a means by which we can engage more in a peer-to-peer fashion, disintermediate these central authorities. But over time, that balance between central authorities and the convenience and the decentralisation promise of the industry is something that's delicate and just needs to play out over time.
Appreciate that. Kelvin, obviously, you're head of trading at Coinhako, so if you got to make a run, no problem on that. But I've been seeing that CeFi in regards to crypto exchanges seem to be a lot more focused towards institutionals, at least institutionals gravitated towards them. UX experience is obviously better than, let's say, in DeFi exchanges. So I don't know if you agree with that, but also a big move where people are anticipating there's going to be a lot more OTC trading. Can you maybe walk us through, again, the delta, if any, right, between how you, who's been building out the trading operations at Coinhako, saw things 2 weeks ago versus now? What has changed, if any, and what's your thinkings in regards to the future of the space, a little bit more from a trading kind of perspective?
Yep, so in order to break down how you view this crypto space, you can consider 3 factors. First, the macro environment. Second, liquidity. Third, network adoption. So I will argue, before this year, the third factor dominated, while the second factor was weak. So that's why we saw a huge asymmetric rise in the prices. But this year itself, the first factor, macro, took over. So the Fed's tightening policy or fears of recession actually caused a drop. Let's put it this way: if interest rate was 0, I don't think any of these problems would actually arise so fast. So the macro problems were rising. But from what we observed pre the FTX saga, institutions are coming in, and you are seeing the third factor is actually reasserting itself. That's why when we look at the third quarter, actually crypto assets, Bitcoin, Ethereum actually outperform the TradFi assets, bonds, equities, and even gold. So that was the backdrop. In fact, when we were looking at on-chain metrics as well, we were actually seeing a slow bottoming process. The hodlers, the long-term institutional players, when institutional players come in, what do they provide? Because they are longer-term players, they provide more liquidity. They are less likely to be affected by the short-term macro environment. So that's why factor 2 and 3 will improve and then reassert itself over the first factor, and that is why third quarter crypto was actually the best performing asset. After FTX, obviously, I mean, we do not know when these three factors will reassert itself again, but it will come back again because this is just a temporary event, temporary setback, right? How going forward, what will happen in the OTC space or the C5 space is that what we are already seeing in the OTC space, whereby instead of putting assets on the C5 exchanges, there will be third-party custodians, something like a prime brokerage model, whereby instead of all of us, for example, or institutions putting in FTX, putting in anybody, you put it in a trusted, licensed third party, and only when you want to do some trades, you want to do something, and then you take it out or transfer. So it's very similar to what the FX OTC market is in the TradFi space. Appreciate that.
So, the very easy question here, and I'll open this out to kind of anyone. Obviously, when we had the Terra Luna implosion, I think at one point, it was estimated maybe 40 billion or something like that or more has been lost in value, and that kind of led to a cascade, right? It was 3 Arrows, it was BlockFi, it was Celsius, and so on. Any thoughts on the level of contagion or potential contagion now? There are, as to Dan's point, some rhymes with history. I traded during the GFC. I was on the prop side. I saw the S&P get down to 888. And of course, if you were at a bank, it didn't matter what your bank was. People were kind of gunning for you. So I feel like that's what we kind of have at the exchanges. But I'm just wondering, any thoughts on potential contagion? And what do we need to see here? Is it a price level? Is it a time? Is it, CZ buying the entire space? Any thoughts on that? Anyone can jump in.
Yes, okay. I think if you look at it, it's very difficult to say with 130 different entities connected to it where the pain will fall. But you see that you explained it in your introduction. Traditional finance was hit this time. So where in Terra Luna it was the cryptocurrency investors, now it was the venture capitalists, the hedge funds. They were actually in equity in FTX. So that's a bit different, I think, from those other events. But still, it is time will heal this. I mean, we have to wait what's happening. I think the market was kind of bottoming, and this was a black swan event that nobody saw coming. At least we didn't see it coming. And I think we have to see what is happening. People are actually, I think the withdrawals of central exchanges last week was the highest in a number of times. So people actually think, okay, maybe my coins are safer in my own wallet. I think this is a temporary thing. I think when regulation comes into the space, especially where the deposits are, where people actually can have custody on their digital assets, they will get back to the exchanges as well. But that is an important point where we always say, not your keys, not your coins. You need exchanges to trade. You can do that decentralized, or you can do it centralized. And at this point, centralized exchanges do have a lot more liquidity than decentralized exchanges. So it's hard to get around them, so we better make sure that they're safe.
Yeah, appreciate it. Anyone else want to weigh in?
I will just add, it's too early to tell. So let me give two sides of the coin. You're talking about the OTC. This is a counterparty risk scenario. So for example, let me give an example. So for example, if, let's say, counterparty A is long a Bitcoin put, Alameda is the market maker. You will think that another customer buys the put from you. So as a middle market maker, you are flat, right? But suddenly Alameda is gone, and suddenly you're not long the put. You're actually short the put to the customer, and you do not know whether other counterparties is the same as well. So it becomes a cascading effect. But let me tell you the good side. The good side is that because after what happened to Luna, what happened to 3AC, risk management controls were put in place. So any of these will be settled either daily or in a very short period of time, any of the settlements. Secondly, a lot of the funding, everything will be pre-funded or over-collateralized. So the Luna episode or the 3AC episode actually help mitigate part of this counterparty risk that happened over the last week or may happen over the next 2 weeks.
Yeah.
All right. So just kind of a little bit on kind of the same theme on CeFi and DeFi. I think the interesting thing that also has not been getting a lot of airtime is, of course, DeFi has continued to work, right? Throughout all the meltdown, throughout everything, it's all on chain. No one cares or knows who you are, particularly, which changes a lot of what was, in essence, riding on a lot of authority bias, right? But also, as Maurice also said, we do have this problem where there's a lot more volumes, there's a lot more money that's going into centralized exchanges. True crypto, maxis will tell you, a centralized exchange is not crypto, right? It has to be DeFi or nothing. The whole spirit of the Bitcoin white paper was trustless. That was the whole kind of basis and that kind of architecture there. So when are we eventually going to get a UX experience on DeFi that can actually make it easy or easier, perhaps I should say. I remember buying my first Bitcoin in 2013. It was like pulling teeth.
Yeah,
it was
horrible.
just so tough. So, what's missing? I know none of you guys are CTOs. I do know that you spend obviously a lot of time in this space. But, where are we? Are we 3 years away? Are we 10 years away? And we've been talking about this for ages. Yeah. Any thoughts? Joe, you were laughing, so you can kick it off. Right?
Yeah, it's a horrible it's actually still a pretty lousy experience. And if you think about the best user experience, it's probably like the iPhone. And we are on a flip phone punching in keys right now in DeFi. And quite frankly, until we get to that iPhone moment, where everything is as easy to use as the iPhone and nobody knows it's running on a blockchain and nobody has any idea what the back end is, it will always be stuck in this space. So I feel like maybe we've invented the Netscape browser. We might be that part, but we are so far from this being a seamless experience that I don't really see mass institutional adoption for many years. And quite frankly, the reason people have bank accounts is they don't have to worry about where their money is. And I appreciate that not your wallet, whatever. But the average consumer around the world does not want that. They do not want to have to track down and remember where their USB key is.
Got it.
It's that simple. Like we are very far away from that moment where I think the average consumer.
The friction is just too much. You basically have to go back to use it.
Yeah, how many, I don't know, I'm not going to ask for how many people have multiple wallets, but that alone is ridiculous.
Yeah. Okay. Any other thoughts on this?
No, I tend to agree. I think mass adoption doesn't happen with self-custody. There needs to be the right balance of centralization and decentralization. We can't forget centralization makes sense on so many levels. It's convenience, it's scalable, it's more efficient. It's the pure trust factor that when central parties get too much power, too much control, there is a tendency to abuse that over time. And that's not an outlandish statement, that's just a statement of fact. So I agree with Joe, like mass adoption will occur over time. Maybe there's a decentralized wallet app technology that allows that scalability. But ultimately, I think if assets like Bitcoin become more mainstream currencies, I'd probably be more inclined to expect to see it pop up in your internet banking as another line item next to your currency account. At the end of the day, the current financial system transacts on IOUs. It doesn't transact real value. Yeah. Tap and go with your credit card to buy your coffee. It's convenient, right? Whether I settle my credit card bill at the end of the month in US dollars, Bitcoin, rocks, gold, it's irrelevant. It's a single bulk transfer of value at the end of the month. So how it plays out, I'm not sure. But one additional point that I found really interesting around the DeFi point was with all these entities entering Chapter 11, liquidations, etc., DeFi seemed to work as intended because the contracts were triggered, the collateral was taken back, And under bankruptcy law, which will be interesting to watch play out, often you get these redeemable preference issues where creditors are able to deemed to have a priority, they've got to claim it back. How does that work in this sector? How does that whole DeFi where you don't know the nature of your counterparty? So we're in a completely new world.
There's a little bit of a critique on, proof of reserves in essence, because you're only seeing one part of the potential balance sheet, right?
Yeah.
All right. Maybe before we bring it to kind of Asia, and then we can, refine maybe also different parts of the space, because crypto, Web 3.0 is a lot more than just exchanges, right? It's a lot more than CeFi and DeFi. I'd love to, hear maybe Joe later on some of the things that you guys have been investing in, Maurice, maybe some of the things you're really excited that HODL is building out. But the general consensus and feel like for someone who's been in the space for, I guess, going on plus 10 years almost, is really, really bearish. I think, again, there's a sense of betrayal, there's the sense of fury. If you're in crypto, you're used to 70, 80% drawdowns, you're used to stuff going to zero, but I think it's a lot more personal for a lot of people, and a lot of also anger, also because SBF was a lot more focused on CeFi over DeFi, right? Which is kind of paradoxical. Could maybe people have this wrong, and actually there's massive positive factors that come out of this in one way or another, maybe to a specific part of the ecosystem, or maybe a specific region in the world? I mean, I'd just like to throw that kind of out there as a little bit of a contrarian take. If you had to make a little bit of a case for that, anyone want to take a bat at that?
Well, it all comes back to the technology. If you look at the way data is processed in the global world we're all trading in and acting in, we need our data to be reliable, available, and global. And that is what blockchain brings. And if we just go back to the technology and you start building from there, and you look at all the positive things that come out of there, then the trust will get back as well. And then in the end, the industry will grow. But we need to go back to basis. And there are so many great examples. Even yesterday, somebody told me if I use smart contracting in my bunker fueling, in my ship that goes in 30 days from Singapore to Rotterdam, and it's been sort of shifted ownership 20 times in between, how good is it if you can sort of, at the end, with one smart contract, settle it all? And if we go back to the technology and advance from there, I'm sure the trust will come back. But it will take time, and what you said earlier, how much time? I think people overestimate what happened in 2 years, but underestimate what happens in 10 years. So somewhere in between that, I think blockchain will have a massive role in our economy.
All right.
Yeah, I mean,
Joe, you obviously long billions in the space, so I'm sure you see some positives out of this one way or another.
yeah, well, I mean, the underlying thesis is still intact.
Yeah, crypto's here to stay.
It's here to stay. Blockchain is incredibly powerful. Bitcoin has never been hacked. The network itself has never been hacked. It's never had effectively any downtime. Name a major corporation that has not been hacked and that has not had a downtime. When web services goes down, half the US stops functioning. So, and yet Bitcoin, this hobby basically that began as a hobby, yet has outlasted all of them in terms of reliability, and it's so far been unhacked. There's other areas that are like really fat, where there's lots of intermediation, like payments. I mean, Dan sort of alluded to this, but sending a wire now in the United States costs more than it did when they had the telegraph. Mm. It's ludicrous. Like, why does it take 7 days for a wire to clear? Why does it take 3 days for a stock transaction to clear? All these things could be near instantaneous with the blockchain. So I don't think all of that is going to stop just because of this escapade in the Bahamas. And I'm not making light of it. That's escapade in all caps. So it's going to continue. The technology, there's still $30 billion of venture capital that has been not deployed yet into blockchain technology development. All of that's still getting deployed. The developers are still happening. Social, gaming, all these other areas that don't touch finance are still wide open for development. I think that's all going to continue. We'll all be surprised when it pops out of nowhere 2 years from now and be like, oh, wow, okay, now we're back.
All right. So, was there something on your mind there?
Yeah, I think, in my view, maybe controversial.
Sure.
I think one good thing that will come out from this is that crypto space, we have to go from a more entrepreneurial kind of mindset to a more institutional kind of mindset. Because you look at the FTX management team, for example, you need experience when it comes to a certain level. You need sophisticated pricing models. You need robust risk management frameworks. You need clear regulation. So all this episode will speed this thing up. You need people with experience to take over and then build to the next level. So I think this is probably in the long run good for the industry itself.
So I think governance is also a big part of that. And that probably ties back to the macro environment we've had, cheap money, anyone can raise, governance kind of goes out the window with that, right? Turning back to kind of Asia. Obviously, SBF probably not as well known out here as he would have been in, let's say, the US, for instance. But with that said, any thoughts? Is Asia affected maybe differently? Is it maybe diluted? I know obviously Asia is a big place, but just generally kind of speaking, is there any thoughts on that?
Yeah, if you look at which countries got affected by the FTX saga, Asia occupied 3 out of the top 5 countries. So even though SPF might not be well known, this actually hit them quite hard. And there's a reason for that as well. Southeast Asia, I grew up in Singapore, right? So the problem in Southeast Asia, the percentage of unbanked and underbanked, it is 60 to 70%. So they do not have access to basic banking accounts, like what Maurice was saying, or when inflation is high, they have no access to investment. But guess what? Their mobile phone penetration is more than 100%. A lot of the Southeast Asians have more than 2 phones, or more than 1 phone, I mean. So guess what? Having access through digital wallet, basic banking services on their mobile phone is what will attract them. And this is a use case, especially the underbanked or unbanked in Asia as well. So hopefully this will not put off this potential use case in Asia, and especially in Southeast Asia. But yeah, we will see. Like what Joe said, the value proposition of Bitcoin and crypto is really untouched. It's just a blip, hopefully.
Anyone else on Asia in general? Is it the same? Is there going to be some pockets that are out? I think also on top of that, and feel free for anyone to jump in, being here in Singapore, we've seen a lot of talent leave. We've seen a lot of capital leave. I'm sure people out in Hong Kong have also seen the same. I'm sure in Australia, et cetera, Japan. And it's all going to the UAE, predominantly Dubai, which is now seen as the new Mecca, where they seem to have a firm green light rather than the usual orange light that we've seen in a lot of different countries. Any thoughts on the pros and kind of cons of that in general?
Well, I think that people are going there just because of the green light, not because they want to live there or because, although the ecosystem effect is probably pretty significant at this point. I think that if we get green lights in other countries as to what is allowed and what isn't, talent would naturally flow back. This talent just gets on a plane. That's it. Like there is no, there's no real barrier to the talent moving around the world. So I would say that it's a moment in time. And if we get clarity in the US and Europe and other parts of the world and get green lights as to the rules, the talent will flow back to other parts of the world. I don't think that in crypto, because it is a global economy and ideas are global and the people are global, that you can actually claim, any one area can claim dominance for a period of time.
Okay, that's a great point. So with that, gents, let's wrap it up. So you each have about 30 seconds. Keep it potent, what you'd love to leave the audience with. We'll kick it off again down from the bottom and then work all the way back to Joe. Please.
Okay, thank you, Kay. So I think based on last week's episode, I think in order for crypto to move to the next stage, I like to divide this crypto journey into 3 stages. First, digital tokens. Second, digital products. Third, digital assets. We are only on the first stage, digital tokens. We will live in a multi-chain world, but 12,000 cryptocurrencies is just way too many. Too volatile, too many currencies, we are losing our focus. Focus on the ones that actually bring real value and reduce the volatility of the underlying asset. We reinstill confidence in the digital tokens. Then we move on to digital products. What are digital products? So digital tokens become an investable new asset class. So your usual digital product. So this is where we see the institutionalization and financialization of crypto. So what do you mean by that? Prime brokerages, your usual products are structured products, QIS, indexes, everything based on the underlying asset, which is the digital tokens. What's the benefit? It brings about a higher level of sophistication in pricing and more robust risk management. Once this is built, then we can move on to the third stage, which is digital asset, which in my view is actually the killer app, could be the killer app for this space itself. So when this happens, any company, anybody, their market is no longer, or their customer base is no longer limited by geography. It's all in a digital space. So that's where Web3 would truly take off.
Say, only a trader can take 30 seconds and give you a few minutes. Dan from Iris, thank you.
Look, obviously we're playing the sector very differently. We're building out industry-leading data centres to support this transition, using 100% renewable energy. For us, we've been in the sector since 2013. We've seen the cycles. I struggle with crypto. I've got to be honest. I'm on a crypto panel. Bitcoin, product market fit, there's only 21 million. Even as digital gold in a world that's becoming dominated by these digital social networks, gold parity is $500,000-$600,000 a coin. Fast forward 10 years, does that sound so crazy? When Bitcoin is better than gold at every objective metric of gold. For us, we're mining Bitcoin at 9,300 a coin at the moment. Yes, we'd rather it at 60,000, but at 16, 17,000, it's still profitable on a marginal basis. We'll just keep doing what we're doing.
Fantastic. Maurice?
Yes, there's so much to talk about and so little time. But yeah, so if anybody wants to have a further discussion, please welcome after this this panel to have a discussion. Yeah, for us it's easy. We're builders, like I said in the beginning, and HODL stands for hold on for dear life, and we don't mean hold on to your coins, but hold on to these technology that has been given to us, and that we're gonna build further on the shards that are left for us a week ago, and I'm sure we come out stronger and more resilient. And that means that the outlook is actually the future for APAC, that digital assets will have a place and will emerge really big, and we're happy to be contributing to that.
So bear market's the time to build, right?
Bear markets are times to build, most definitely.
Joe?
All right, time this. But so crypto was born in a global financial crisis. It grew up in a bull market, and maybe now it's an angry, moody teenager. And it's facing a bear market with high inflation and potentially bear market equities and in bonds as well. And it's basically in the process of growing up. And these moments in time are really difficult, but we'll get through them. Institutions will continue deploying capital. And now is actually the time to be investing. That's when all of our clients historically have made the most money, is investing through the crypto winners.
Kelvin from Coinhako, Dan from Iris Energy, Maurice from HODL, Joe from Cambridge Associates. Thank you very much. Let's give them a big round of applause, please.
Thank you for hosting.